Hello guys, welcome back to my channel. Don't forget to like, comment, share, and subscribe. Forecast for the terminal rate hikes new hike, shaking stock and bonds. Expectations of how aggressively the Federal Reserve will raise rates in its fight against inflation hits a fresh high this week, exacerbating pressures on stock and bonds. As investors await another jumbo rate increase from the U.S. Central Bank at its September 20 until 21 meeting, higher than expected inflation numbers have ramped up bets on the so-called terminal rate, which now stand at 4% revenues data showed. That is more than 200 basis points higher than the current benchmark overnight interest rate and compares with a projected peak of about 3% just a month ago. Higher U.S. internet rates are potentially unwelcome for stock, which rallied over the summer, while bond yields, which moved inversely to prices, returned from their hikes on hopes that the Fed will ease the pace of rate hikes. Those hopes were dashed this week when the U.S. Consumer Price Index for August showed inflation rose on an illicit basis more than economists' forecast of 8%. I think the Fed is going to put another 150 basis point to 200 basis point of rate hikes into the market. But it's the speed with which they do it which is the debate at this point. Jeffrey Sherman, the Fed's chief investment office at Double Line, said. Expectations of a more hawkish Fed have also boosted real yields, which show how much an investor can make on an annualized basis holding a U.S. government bond and do the allure of riskier assets when they rise. Yields on the 10-year Treasury inflation-protected securities or TIPS, known as real yields because they strip out projected inflation, climbed to 1% on Friday, their highest since January 2019. Since the beginning of August, real yields have gone up by about 100 bps. Meanwhile, benchmark 10-year Treasury yields have climbed about 8 basis points this week to flirting with a new 11-year high as they go above the level they hit in June. Goldman Sachs said in a note on Friday last yield called in the year at 3%. The picture is not any rose for corporate debt. Investors don't appear to have much confidence in the Fed's ability to engineer a so-called soft or not so hard landing, said Daniel Pauly, CEO for portfolio manager of Oaktree Diverse Income Fund. The yield spread for the ICB for a U.S. High Yield Index, a commonly used benchmark for the junk bond market, has gone up to nearly 480 basis points this week from 450 bps before the CPI report. A sweep rise is generally bad for spreads when growth is below trend. Basically, strategizing in not on Friday, we do not think that this team will be different, they said. U.S. SEC crypto guidelines push up costs for lenders drafting projects. Banks' cryptocurrency projects have been upended by U.S. Securities and Exchange Commission accounting guidance that would make it too capital intensive for lenders to hold crypto tokens on behalf of clients, according to more than half a dozen people with knowledge of the matter. A slew of lenders, including U.S. Bank Crowd, Goldman Sachs Group, Inc. But on March 31, the SEC said public companies that hold crypto assets on behalf of clients or others must account for them as liabilities on their balance sheet due to their technological, legal, and regulatory risks. While the guidance applies to all public companies, it is especially problematic for banks because their strict capital rules overseen by bank regulators require them to hold cash agreed at balance sheet liabilities. The CA did not consult the banking regulators when issuing the guidance. According to four of the people, the SEC moved complicated banks' effort to jump on the digital assets bandwagon and could keep them on the sidelines even as they report increased demand for clients looking to access the bargaining market. Maybe that's all from me. Don't forget to like, comment, share, and subscribe. Thank you.